Okay, so today my presentation is about how we fund the road trip to scale for 3D printing businesses. Essentially, I'm going to be looking at the dynamics of access to finance for 3D printing, mostly for startups, and I'll explain why I'm focusing on startups in a moment. I'm quite interested in the positive ripple effects that flow or potentially could flow from the disruption that's caused by this type of additive manufacturing. And I'm going to take you deep into corporate law to look at, I know it's a riveting prospect, to show you how the law has recently responded to its own form of technical disruption in terms of the introduction of fintech and peer-to-peer lending processes to embrace equity crowdfunding. Now, this is really interesting because it brings into the scope of the discussion issues with gatekeeper liability. And I have some concerns for how gatekeeper liability could actually throttle the potential of 3D printing. It also has the potential to impact the preparedness of fintech to allow unsophisticated investors access to funding opportunities. And I'll explain to you what all of this means. So I'm also going to then look at some of the lessons from the experience of the 3D printing businesses in Australia, not just with the larger entities engaging in IPOs and listing on the ASX, but also in the smaller projects that have relied on reward-based crowdfunding. And essentially, I'm going to focus on these 4 standout issues. Access to finance for public and private companies, what I'd like to call the valley of death and the innovation cycle, looking at crowdfunding, gatekeeper liability, altruism, and the liquidity of investments, and finally, risk and ripple effects. So you might recall that in late 2015, the, I think still current government, although with a different leader and Prime Minister, announced our latest National Innovation and Science Agenda. Now, what I really have found after the last several years of researching innovation, entrepreneurship, micro, small and medium enterprises is that people rarely understand what these terms mean. So I find it quite fascinating to listen to politicians explain their policy because they will quite dramatically switch terminology constantly as they work through their statements. So I think it's quite appealing for them to use terms like small business, SMEs, because most people sitting in their lounge rooms at home listening to these statements will think, oh, I'm a small business, or I'm an entrepreneur because I'm self-employed. But that's not actually the market that they're talking to with this National Innovation and Science Agenda. They're looking at businesses that are engaged in entrepreneurial activity, which at its micro focus means that the activity is innovative. And innovation at its heart is novel. So of all of the businesses that we have in Australia, those that could genuinely identify as engaged in entrepreneurial activity that is in itself innovative would be microscopic. And among those businesses are 3D printing businesses, which is why I have really quite enjoyed using 3D printing as a lens for my research, because it is quite genuinely the focus and the goal of this policy to support these particular businesses. In looking at the types of entities that are engaged in 3D printing, I was quite surprised to see some of the larger ones still describing themselves as startups. So I have come to a new appreciation of what a startup is. I think that a startup might actually be a badge of honour that most businesses that consider themselves a startup wear with some pride, because a startup indicates to the market quite a few things, but it indicates to the business people themselves that they have their eye in the sky. They are targeting growth, rapid growth, high growth, or perhaps to reach a scale where the business itself becomes the commodity, so that they are ripe for takeover or merger or acquisition. So these are the things that are quite unique, I think, in looking at corporate law in this way to try and see how this National Innovation and Science Agenda has tried to come up with a situation where it can support risk-taking in entrepreneurial, innovative businesses, particularly those that are new and startups. And this is where access to finance is relevant. The financing needs of any firm and the nature of any financing gaps experienced are going to vary considerably during the life cycle of the firm. And within the life cycle, they are going to vary even more during periods of growth. And that's one of the reasons why we need to be a strong, vibrant economy. We need lots of different financing options available at various points along the pathway to firms of different sizes and shapes along the way. This is critical. The financing needs and gaps are going to turn in part on the structure of the firm, the entrepreneurial goals of the organisation, the nature of the innovation, and the growth potential of the firm. So we're talking about corporate fundraising. Corporate law tightly regulates how companies can raise funds by attracting investment in exchange for equity. Funds can be raised from the public by listing on a prescribed financial market. Probably the best known one is the ASX. The catch is that in order to list, the company must already have achieved a certain scale. And the barriers to entry include prerequisites of size and income. In practice, the company must already be a public, unlisted company because it needs to have at least 300 non-employee shareholders. And you can't do that if you're a proprietary company. It also needs a track record, and the details of the track record that the company needs is on this slide. And you can see that these are pretty steep track record indicators that are needed. Now, these thresholds were increased in 2016, and there is still considerable concern that the lifting of the requirements has the capacity to thwart the listing specifically of innovative tech startups without a proven history of investor interest. And what's interesting about that is that these were being debated at exactly the same time that two of the IPOs of our 3D printing companies in Australia were going to market. So in recent years, we've had Titomic, Robo3D, Aurura Labs, and the Melbourne-based Triple 3D all engage in IPOs on the ASX with varying degrees of success. The IPOs were strong. In August 2016, just 2 years after its initial formation as a proprietary company, Perth startup Aurura Labs raised $2.8 million with its IPO. A couple of months later, the Californian startup Robo listed on the ASX in December 2016, and it raised the maximum of $6 million with its IPO. Now, IPOs, given that both these companies identified as startups, would be considered as a stepping stone to facilitate further growth on their road trip to an even bigger scale. Now, what's interesting is when you look at the ASX performance of these companies, they are all very similar. And these shots are taken from the ASX this morning. Now, just ignore Titomic for a moment. If you look at the shape of the curve of all three of the other companies, you can see they follow a very similar downward trend. Now, if you consider that Titomic's length of the time it's been listed is quite short, it doesn't have the same timeline as these other companies. It's really at this point in its development. So it may yet follow the same sort of trajectory as these other firms. So why is that the case? Well, I think that one thing that we can look at here is that what these are showing is that the sophisticated types of investors that engage in these IPOs with high-tech companies do have an appetite for high-risk investment, but they have an equally corresponding appetite for reward, and they expect that reward to be higher because of the risks that they're taking. And some are clearly not prepared for the long wait while the 3D printing industry continues to experiment to see what this technology can make possible. So listing offers a liquid market for the investor. The investors can sell their shares on the ASX, and it facilitates access to capital markets for foreign companies, and it can increase awareness of the entity's business. But it's not always a feasible option for companies because many companies just simply will not be able to reach the thresholds to list. So what about smaller companies? Very few companies in Australia are listed. We have over 2.2 million registered companies, and only about 2,000 of those are public companies listed on the ASX. Most companies are not that big. Most companies are micro companies. And of the micro, small and medium enterprises, we're talking about 99.9% of all Australian companies falling within this size. Most of those companies are proprietary companies that are limited by shares. They haven't reached scale. So for these companies, especially those that are innovative, entrepreneurial startups, they have a gap in their funding because of their size and the range of their development. And that's what I've tried to illustrate on this slide, which I'll talk you through in a moment. For most startups, capital is a priority during the window between concept development and setup or prototype development. And it's this point in the innovation cycle that can present as a make or break capital gap for startups. And at this fledgling stage, it can be really difficult for firms to attract any investment. Now, the diagram that I've got here is quite controversial. Some scholars don't like to present the innovation cycle in a linear fashion like this because, quite rightly, they argue that the growth of any firm is not likely to be the same as the growth of any other. I accept that. They also say that time is not necessarily a relative predictor of growth, and that's exactly right. But when you do look at it linearly like this, you can clearly see the gaps, and the gaps help us understand what the potential role is for crowdsourced equity funding. It also explains why so many fledgling companies fail, particularly those that are innovative or startups. So, at this beginning point where we have the idea or the concept, we might be using seed grants, funds from internal sources, and then we have this gap between concept development and prototype development. Now, we need to get through this gap because during that time, we haven't really got any track record that's enough to attract sophisticated investors, like what we might be able to get from angel investors or venture capitalists. We're certainly not going to attract interest in terms of merger acquisition or be at any point ready for public listing. Debt finance could be an option, and this is where we see the real overlapping of personal wealth and business risk, because quite often debt finance at this stage would be relying quite heavily upon you guaranteeing loans to your entity or perhaps the borrowings personally. And we know that very few bankruptcies in Australia, personal bankruptcies, are a consequence of business failure. So which is an interesting point because so many of these businesses do fail at this really early stage when they can't attract funding, which is why I've called it the valley of death. How do we get through this? Now, this is really interesting for two reasons. The first one, which I'm going to talk about now, is how crowdsourced funding or crowdfunding of any type can fill this gap. The second thing that I'd like to point out, which is a conclusion that I come to in my presentation today, which is the role that 3D printing can play beyond its own industry to actually shrink this gap, this time period between concept development and prototype development for many other businesses. But let me talk first about the capital. Okay, so crowdfunding. In the past year, 2 quite significant amendments have been made to the Corporations Act to facilitate support for new and innovative entrepreneurial companies. It was the policy statements that accompanied these amendments to the law that talked in particularly about high-tech startups. So now the law is that unlisted public companies and proprietary companies that have less than $25 million in consolidated assets and annual revenue can offer ordinary shares to unsophisticated investors. The company can raise $5 million in any year. Now, who is an unsophisticated investor? An investor is not an unsophisticated investor if they have experience in investment, if they have experience in using financial services, they have the capacity and experience to assess the merits of the offer, the value of the offer, the risks, their own information needs, and the adequacy of the information that they've been given about the offer. If you're not a sophisticated investor, then you are a retail investor and you can engage in this crowdsourced equity funding. As a retail investor, your capacity to invest with crowdsourced equity funding companies is capped at $10,000 per year for the same company, and you have the opportunity to take advantage of a cooling off period. Companies that choose to raise funds in this way have additional financial reporting requirements and corporate governance obligations, and where more than $3 million is raised, there are audit requirements. Now, what's unique about this is that it changes the shape of what our proprietary companies usually are, because our proprietary companies are private. They usually have less than 50 non-employee shareholders. Their reporting requirements are minimal, if anything, because they are usually owner managed, and that is reflected in the existing requirements of the law. So this is quite sensibly in terms of investor protection, saying that if you're going to engage in this sort of fundraising from the public, increasing the number of external investors, then you need to be accountable for that in terms of your financial reporting and also the way that you keep your books and records and governance. That all makes great sense. I do wonder, though, whether in practice, when the more and more companies begin to engage in crowdsourced equity funding, whether the companies themselves are going to be sophisticated enough to take on another 5,000 to 10,000 investors who participate in this crowdsourced equity schemes. We have seen the pain in the media from large innovators in coping with accountability to a large shareholder base rather than having complete control and ownership of their innovative business. Now, what's interesting about problematic, I think, about the crowdsourced equity funding amendments is that companies that want to engage in this type of fundraising have to make an offer through a facility that has a dedicated crowdsourced equity funding Australian financial services licence. And we've had 7 of these granted so far. The legislation describes these as intermediaries, and these intermediaries are innovative themselves, innovative fintech. The legislation casts a range of obligations upon them to vet the companies that are engaging in the financing. They have to vet the fundraising opportunity, and they have to ensure that the unsophisticated investors are protected. These are called the gatekeeper obligations. Now, there's a tension here because the fintech are engaged in a new business themselves, so they will want their own commercial success, and they can only have that if they are facilitating these crowdsourced equity funding campaigns or other campaigns. So they want to attract business, but equally they don't want to be exposed to gatekeeper liability as these private regulators of crowdsourced equity funding. So what's happened here is quite interesting. The idea was that they would police the campaigns, and that only the campaigns that would be most suitable for crowdsourced equity funding would be present on their platform. Perhaps they're doing that. But the unintended regulatory effect of the gatekeeper obligations seems to be that the fintech themselves are locking down the campaigns so that unsophisticated investors can't see them. So only sophisticated investors seem to be able to gain access to most of the crowdsourced equity funding campaigns that have been run. Now, there haven't been very many of them, but these are just things that I'm noticing in my observation of these early campaigns. The next stage for my research here is going to focus on how these platforms engage in managing their gatekeeper obligations through an empirical project. Now, there has been some crowdsourced equity funding, there has been some crowdfunding that's focused on reward-based funding. And what's interesting about the 3D printing experience with these is they seem to act most successfully where the reward that the participant receives is the 3D printer themselves. So it's kind of like deferred online shopping. You're making a bet that if you make your pledge, eventually you'll get this fantastic 3D printer. And one of the most successful campaigns so far has been for the Obsidian plug and print 3D printer, which attracted more than 6,000 backers, pledging more than $1.6 million on Kickstarter. That campaign closed more than a year ago, and the first batch, you'll be pleased to know, is getting close. If we look at another campaign, which was QUT's own Future Here campaign, this was really more an altruistic campaign where you were given the opportunity to pledge funds to support the development of the 3D printed ear. So you didn't get the product reward, you got the reward of supporting this really good cause. Its fundraising goal was $200,000. It attracted $30,000 from 185 supporters. So there looks to be some sort of limit to the altruistic crowdfunding successes for 3D businesses. So my final point is about risks and ripple effects. It's really important, I think, that we continue to reflect and refine how we can get access to finance right for 3D printing businesses, and that we can understand that the businesses that are engaged in this process are large companies and also startups at various points along the scale. So we need to provide really quite flexible framework for access to finance. Given the place that this decentralised form of manufacturing has in supply chains and the possibilities of reduced production costs and speedy prototype development that's produced in this discrete manufacturing, then the success of 3D printing businesses could be entwined with the success and survival of big business innovators, creators and makers that are all utilising their services and are on their own growth curve. So supporting 3D printing businesses could support other startups, and this has the potential to dramatically shrink that window between concept development and prototype development for all innovators and creators. So the early experiences of 3D printing companies should encourage policymakers to continue to refine access to finance options. I do think that there is call here for the real lesson for government to take on board is that it is time to completely overhaul our corporate law. The process of introducing crowdsourced equity funding has really shone a light on the fractures in our corporate law, because it has just been a ridiculous amount of time since it's been reformed. It's looking still quite similar to it did in 1855 when limited liability was introduced. And I think it's time for us to join the world stage with changing the way that we think about our corporate law and to simplify it for the modern business. And if it's of any interest of you to discuss later, that is my role in UNCITRAL Working Group 1, where we look at how to improve simplified business entities for micro, small and medium enterprises in developing countries. Thank you.